If you're a high income earner, you're in a very unique financial position. You have more earning power than the average person, but that also means you face higher taxes, more complex investment decisions, and a greater need for strategic planning to maximize your wealth. The biggest mistake high earners make: investing in the wrong order. Today, I'll break down the optimal order of investing for high income earners in 2025, using a 4 level framework that ensures that you're making the best decisions with your money at every stage. By the end of this, you will know exactly where to put your next dollar and how to build wealth efficiently and make sure you're making the most of every dollar that you have. And if this is your first time visiting the channel, my name is Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's get started. Before you think about investing, you need to secure your foundation. Without these steps, unexpected expenses or downturns could derail your financial plan. So step one, and this is relatively simple and straightforward, is you need to have an emergency fund. High income earners tend to have higher fixed expenses, larger mortgages, private school tuition, and higher lifestyle costs. That's why 3 to 6 months of living expenses in a high yield savings account is the minimum recommendation. If you're a business owner or you work in a volatile industry where a lot of your compensation is made up of stock options, consider holding a year's worth of expenses to protect yourself from unpredictable income fluctuations. Without an emergency fund, you might be forced to liquidate investments at a loss or rack up high interest debt in an emergency. Having liquidity protects your investments and keeps your long-term strategy intact. The second step is to pay off high interest debt. Very few investments can consistently beat a 20% credit card interest rate. Paying down high interest debt is a guaranteed return on your money, making it a priority before we start investing elsewhere. One of the best methods to use is to utilize the avalanche method when you're prioritizing paying off your highest interest rate debt first. And when that debt's gone, going to the next highest interest rate debt until that debt's gone, and then so on and so forth until you completely eliminated all high interest rate debt from your portfolio. Some people prefer to use the snowball method, but I find for a lot of high income earners, it doesn't make sense to get rid of the smallest balance first, because you're not looking to maximize monthly payments. You typically have enough excess funds to spend how you want to spend your money on a monthly basis, but you're not maximizing your interest, the interest that you're paying. And that's why it makes sense to follow the avalanche method as opposed to the snowball method. If you have private student loans with an interest rate above 7%, refinancing them to a lower rate can save you thousands of dollars in interest. And that really goes for any type of debt that you have. Anything that's higher than a 6 or 7% interest rate right now, you probably want to consider refinancing down to a lower rate if possible. This will save you money and cash flow to redirect towards your investments or to spend elsewhere within your portfolio. Another thing you should be doing at this stage is investing in yourself. So before you think about investing all of your dollars in the stock market or another business, you want to invest in your ability to earn more. Oftentimes, a $10,000 certification could increase your salary by something like $30,000, $40,000, $50,000, and that pays for itself in just a few months. Or going back to school and getting something like an MBA or Master's of Science because your job requires it for the next level of promotion to get more specialized training in a field can accelerate your career. It can even further accelerate your income. Step 4 within the first level that we are following here today is you need to protect yourself. You've built a great career, you've made a lot of money, and now the worst thing that can happen is that something outside of your control comes along and tries to derail your plan. You need to make sure that you have the proper amount of life insurance to protect those you care about, and the proper amount of disability insurance to make sure that you're protecting your income in case something unfortunate happens to you. I've often seen this be the number one reason why somebody who's humming along and doing a great job of building their wealth become completely sidetracked and derailed and have to take years to recover because they didn't properly insure themselves for a couple $1,000s a year. You have the means to do it, so not doing it is a risk you can't afford to take. And before we go any further, be sure to subscribe to the channel and hit that like button if you're finding this content valuable. I would very much appreciate it. My team would very much appreciate it. We love connecting with new subscribers. Now that your financial foundation is in place, the next step is to maximize tax advantage accounts where that allows your wealth to grow efficiently while minimizing your tax burdens. These accounts provide either immediate tax deductions, which reduces your taxable income today, or allow for tax-free withdrawals in retirement, significantly increasing long-term returns. The key is to strategically prioritize contributions to accounts that align with your income level, employer benefits, and long-term goals. Each of these accounts plays an important role in your financial strategy, and when leveraged correctly, they can help you build significant tax-efficient wealth over time. The first account is the employer-sponsored 401k, and those contributions, you want to utilize them to maximize your employer match, and then beyond the employer match, what you can do to reduce taxable income and save for retirement. So a 401k is one of the most powerful tax advantage investment vehicles, especially when an employer offers a matching contribution. Failing to take full advantage of this benefit is leaving free money on the table. If your employer matches 100% of contributions up to 5% of your salary, that's an instant 100% return, completely risk-free. Even a 50% match up to a certain percentage significantly increases your total compensation. So for 2025, the employee deferral limit is $23,500, and then the employee and employer combined limit is $70,000 for anybody under the age of 50. Anybody over the age of 50 can contribute $77,500 to $81,250 more, depending on your age. So for traditional versus 401k debate, I'm often asked, what is the best? Should I do a traditional or should I do a Roth when it comes to making contributions to your 401k? And my answer is it depends. It depends on your income level. It depends on what your income level is going to be in retirement. And it depends on how aggressively you're saving. So as far as a traditional 401k is concerned, contributions lower your taxable income today, but are taxed upon withdrawal. And this is best for high income earners, especially those who are expecting lower tax rates in retirement. Now, a Roth 401k might be better for somebody who makes a little bit less money because contributions are made with after-tax dollars, but withdrawals, including gains, are made completely tax-free in retirement. And that's, like I said, that's best for those who are expecting higher tax rates later, or for those who are making less money now than they expect to make in retirement. And some investors do split contributions between both to hedge against future tax uncertainty. And I don't think that's the optimal approach. I think using the optimal approach is typically using one or the other, but I can appreciate somebody who would want to hedge taxes both ways and would take advantage of both types of 401ks within their plan. The next level 2 recommendation you want to consider is using an HSA if you have access to one and are part of a high deductible health plan at work. Unlike traditional retirement accounts, HSAs don't have required minimum distributions. After age 65, HSA funds can be withdrawn for any purpose, not just medical expenses, with withdrawals taxed as ordinary income, similar to a 401k withdrawal. The best strategy is to pay medical expenses out of pocket while letting your HSA grow, allowing investments within the account to compound tax-free, and then utilizing those compounded returns and that higher balance to pay off medical expenses somewhere down the line, typically in retirement. Another thing you want to consider is to utilize a backdoor Roth IRA. Many high-income earners exceed the income limits for a direct Roth contribution, but the backdoor Roth IRA provides a workaround allowing tax-free growth and withdrawals in retirement. So how it works is you contribute to a traditional IRA as a non-deductible contribution. You then take that non-deductible contribution and convert it to a Roth IRA. You pay minimal or no taxes on the conversion. If there are no other pre-tax IRA balances, then you wouldn't be subject to the pro rata rule. So that conversion essentially takes a non-deductible traditional IRA contribution, makes it Roth immediately, and now you have a Roth contribution in that account that can grow tax-free and be distributed tax-free in retirement. Somebody in their mid-30s to mid-40s has a lot of time to allow compound interest to work in their favor, so it wouldn't shock me if that initial $7,000 contribution today is worth $25,000, $30,000 tax-free to them in retirement when they're done working. So for 2025, the Roth IRA income limits for single people, the phase-out begins at $151,000, and then they're completely prohibited at $166,000 from making a direct Roth IRA contribution. And for married filing jointly individuals, the phase-out begins at $236,000 and is completely prohibited at $246,000. So why do we use a Roth IRA? Well, again, they're tax-free withdrawals in retirement. There's no required minimum distribution. It's a valuable estate planning tool if it's something you want to pass on to your heirs after you're gone. They'll have to liquidate that account over a period of 10 years, but all those distributions that those beneficiaries that you place on the account take, they don't have to pay income taxes on the distributions. This is a great way to give your kids or your grandkids a leg up as they're starting their lives after you're gone. If you already max out your 401k and HSA, the backdoor Roth IRA is a must to secure tax-free growth. Now, the other thing you can do is you can continue by maxing out your 401k beyond the match. After securing your employer match, maxing out contributions to your 401k is the next logical step. If you're in the 32% tax bracket, maxing out at the $23,500 a year, assuming you're under the age of 50, reduces your taxable income by about $7,500. The earlier you invest, the longer your funds benefit from tax-deferred growth. If you expect lower tax rates in retirement, prioritize a traditional 401k to defer taxes now. If you expect higher taxes in retirement, prioritize a Roth 401k for tax-free withdrawals later. For flexibility, contribute to both to hedge against future tax changes. Now, some employers will offer what's called a mega backdoor Roth 401k contribution, allowing you to contribute beyond the standard 401k limit and convert after-tax contributions to a Roth IRA. So how it works is if you make an after-tax contribution to your 401k in excess of the $23,500 limit, those funds are considered a non-deductible contribution. Similar to the Roth IRA conversion strategy, you can take the excess amount up to the overall limit of $70,000 for anybody under the age of 50. and convert those to a Roth IRA or Roth 401k immediately. Future growth on these funds is tax-free, and just like the Roth IRA, that money can be distributed to you tax-free in retirement. And you should use this strategy if you're a high-income earner who has maxed out the 401k, maxed out your Roth IRA, maxed out your HSA, and you're just looking for more tax-deferred growth. Now, while you won't get that upfront tax deduction, the money within the Roth 401k will grow tax-deferred and then be distributed tax-free in retirement. So this is another way to get a little bit of a tax shelter around your accounts without having that tax drag on the portfolio that you would get in a taxable brokerage account. So some final thoughts here is high income earners can significantly reduce taxes and accelerate retirement savings by leveraging tax advantage of accounts. Now, there is an optimal contribution order, and this is always subject for some debate, but I believe you should always start with your 401k contributions up to the employer match. That's a 100% risk-free rate of return on the money that they are going to match for you. So this is a no-brainer first and foremost. You should look at maxing out your HSA next because it's the most flexible and technically provides you a little bit more liquidity should you have a health event prior to the age of 59 and a half, when you can access the other accounts like your retirement accounts like your 401k in your IRA without a penalty. You should look at utilizing a backdoor Roth IRA or the backdoor 401k. The Roth 401k example we went through next is the third step. If your employer offers a mega backdoor Roth, I would utilize that prior to doing the backdoor Roth IRA, but doing one or the other is definitely the third step you should take when it comes to maximizing your contribution order. The next one is maxing out your 401k, making sure that you're taking advantage of the tax deferral piece of it. You want to make sure as a high income earner, you're getting every dollar of deferral today that you can possibly get, because tax savings today are worth a lot more than future tax savings by having a Roth 401k later on. So if you're somebody making $500,000, $600,000, $700,000 a year, being able to claim a deduction of $23,500 a year against your income, saving you about 37% in tax of that contribution amount, is going to save you somewhere in the ballpark of $8,000 to $9,000. That's money that you will get back directly today. It'll increase your cash flow on a monthly basis, and it'll save you money overall in your financial plan as you head towards retirement. And then by maximizing these tax advantage accounts, you minimize lifetime taxes while allowing your wealth to grow as efficiently as possible. If you're liking what you're seeing and you want to dive a little bit deeper into these strategies, check out more of the videos on my channel. I go over all of these options in depth in other videos. If you're not quite as well versed in one topic as the other, I would suggest watching those videos because they break down exactly what I'm saying here at a very granular level. So now we're moving on to the level 3 recommendations. And this is after you've maxed out your tax advantage accounts like your 401ks, your IRAs, and your HSAs. Now it's time to start focus on building wealth through taxable investments. A taxable brokerage account offers greater flexibility as it allows you to access funds without withdrawal penalties, unlike the retirement accounts that we just talked about. However, since these investments are subject to capital gains, implementing tax-efficient strategies is crucial to minimizing tax liability and maximizing after-tax returns. Wealth diversification beyond traditional stocks and bonds can further enhance financial security and passive income generation. So let's talk a little bit about taxable brokerage accounts. And this is like a flexible investing strategy. So a taxable brokerage account allows you to invest in a wide variety of assets, including stocks, bonds, mutual funds, and ETFs, without the contribution limits imposed by the tax advantage accounts we covered. Unlike IRAs or 401ks, these funds can be accessed at any time without age-related penalties, making them a powerful tool for early retirement planning, major purchases, or supplemental income. So there's some tax-efficient strategies you can follow for brokerage accounts. One is to make sure you're taking advantage of long-term capital gains. If you buy a security and hold it for more than 1 year and then go to sell that security, especially one that has increased in value, you'll pay a lesser tax rate known as the capital gains tax rate, as opposed to if you held that security for less than a year and sold it at a gain. You would be subject to ordinary income tax rates in that instance. So make sure you're taking advantage of the holding period of securities so that way you can take the long-term capital gains treatment as opposed to the short-term capital gains treatment on disposition of those securities. Next, we want to focus on dividend investing. Now, qualified dividends receive lower tax treatment compared to ordinary income, making them an attractive option for passive income. So making sure that you're investing in dividend-paying stocks and holding those the appropriate amount of time so that you have a qualified dividend will lower your overall tax burden, as opposed to continually making changes within your portfolio that don't meet the time requirements for dividends to become qualified. You can also take advantage of municipal bonds. These are government issued bonds by a local municipality. I'm in the city of Pittsburgh, so a municipal bond might be issued to repair one of the bridges in our city, and the benefit is they're tax-free. So municipal bonds might pay something like a 5% coupon rate. So if you put in $1,000 in a municipal bond, coupon rate's 5%, I get a $50 payment. Now, in a normal bond or a corporate bond, that 5% payment would be taxable, or the $50 I got for my $1,000 investment would be taxable. But because I chose to invest this in a municipal bond, it's triple tax-free at the federal, state, and local levels. Now I don't have to pay taxes on my interest where I'm getting that $50 coupon payment from investing in my municipal bond. Moving forward, outside of just like investment selection, is we can utilize something called tax loss harvesting to reduce capital gains taxes. Tax loss harvesting is a strategy that involves selling investments at a loss to offset taxable capital gains. This effectively reduces your tax liability. This strategy is especially beneficial for high income earners because you tend to be in the top capital gains tax brackets, which are 20%. Factor in your net investment income tax as well on that. You could be paying an additional 3.8% on top of that 20% for an effective 23.8% tax burden on the disposition of those assets. So selling certain securities at losses to offset potential capital gains and immediately reinvesting those securities to avoid the wash sale will be something that can drive down your overall tax burden in your portfolio. In addition to offsetting your gains, you can also take a $3,000 deduction against ordinary income if you have losses in excess of your capital gains. So let's walk through a scenario where you realize no capital gains for the year, but you do realize $10,000 in losses. Well, those $10,000 in losses, you take the first $3,000 and you can apply them against your ordinary income to drop your ordinary income by $3,000. The remaining $7,000 though then carries forward to the next year to offset future capital gains or to be used to offset income in future years as well, carried forward until that entire amount is exhausted. And again, you want to make sure you avoid the wash sale when you're doing tax loss harvesting. So to claim the tax benefit, you must not repurchase the same or substantially identical security within 30 days before or after the sale of a security at a loss. I made a video on this about last week, and it goes over the wash sale rule in depth. I would suggest you take a look at that video just to get further clarification if this is a new concept for you. The third thing you can consider is real estate investing or building wealth through property. Real estate provides multiple avenues for wealth accumulation, including rental income, appreciation, and tax advantages. While direct real estate ownership requires hands-on management, there are alternative ways to gain real estate exposure with less involvement. So some of the other real estate investment strategies are, rental properties, investing in a rental property, generating passive income and appreciation over time. Owners benefit from tax deductions on mortgage interest, property depreciation, and maintenance expenses. You look at something called a real estate investment trust or a REIT for the more passive investors. So a REIT allows investors to gain exposure to real estate markets without directly managing the properties. Publicly traded REITs offer liquidity, while private REITs often provide higher potential returns with less accessibility. You can also look at short-term rentals. So platforms like Airbnb or VRBO allow for higher rental yields in prime locations, though they come with regulatory considerations and high turnover costs that you need to be aware of. You should also consider some alternative investments beyond just stocks and bonds to diversify your portfolio. So alternative asset classes can provide portfolio diversification, risk mitigation, and inflation protection. So some of the other alternatives you can look at are private equity and venture capital. So if you're making a level of income over, $500,000 a year, $400,000 a year, you're probably an accredited investor. So investing in private companies or startups can provide high rates of returns, though liquidity is a risk, but you do need to be an accredited investor in order to be able to access these types of opportunities. Same thing with hedge funds. You can use advanced strategies like long, short positions, arbitrage to generate returns in various market conditions that can act as a hedge against your overall index fund portfolio, which is typically what most people are following in their retirement accounts and taxable brokerage accounts. You get other things like commodities and precious metals. So investing in commodities like gold, silver, and oil can act as an inflation hedge and portfolio diversifier, which will bring down risk if the overall market goes down. Typically, we see these positions in a portfolio remain relatively stable or increase in value, which will help offset any potential decrease in the overall market. Finally, you can look at something like cryptocurrency or blockchain assets. Now, digital assets are much more speculative and much more volatile, but they do offer growth opportunities that I don't think you could have in the traditional markets. Now, this isn't to say you should put all 100% of your assets in these types of investments, but allocating a small portion of your portfolio, say 1 or 2%, can provide you with the potential for long-term growth on a very, very small portion of what you have overall. So the fourth and final level I want to talk to you about now is estate planning. And estate planning by its nature is very complex. So I'm just going to touch on some of the high level tools that we help clients utilize. You'll also want to consult your CPAs and your attorneys here as well, because they're going to be crucial to getting this part of your plan set up along with your certified financial planner. So beyond just investing, wealth diversification should include estate planning to ensure assets are protected and efficiently transferred to heirs or charitable causes. So the first thing you'd want to consider using is something like a trust. And establishing a trust helps minimize estate tax and provides structured asset distribution. Utilizing something like life insurance inside of a trust is a great way to help pay off potential estate taxes at your passing, and allows the trust to potentially retain assets through that payment of the life insurance benefit. The retained assets are then distributed to the trust beneficiaries per the rules you establish at the trust inception. You also want to make sure that you're utilizing gifting strategies today. So the annual gift tax exclusion for 2025 is $18,000. This allows for tax-free wealth transfers without reducing your lifetime estate tax exemption. So for a married couple who has two kids, spouse one and spouse two can give the first child $18,000 each through by electing gift splitting, or $36,000 in total. The same thing for child two. Now, if your children are married, you can also do the same thing for their spouses. And if they have kids, you can do the same thing for their kids. This is a great way to utilize gift splitting to help remove money from your taxable estate now, so it's less money that your heirs will have to pay at your passing, and it gets them the money today to use for whatever they want to use it for. The other thing you want to be aware of is the step up in basis of shares or assets that you own at your passing. So heirs inherit assets at their fair market value at the time of death. This eliminates unrealized capital gains taxes. So in an instance where you might have bought an Apple stock back in the day when it IPO'd at like $1 a share, and now that Apple stock's trading for $200, $300 a share, at your passing, your beneficiary will have a cost basis in Apple at the $300 per share that it is now, whereas you would have had it at $1 a share. So walking through the implications here, if you owned 1 million shares of Apple at a cost basis of $1 a share, and you sold it for $300 a share, you would have $299 million worth of gains that you would have to realize through that sale. But because you passed away and somebody inherited those assets from you, they get a step up in cost basis. So that $300 million that those Apple shares are worth today, they're effectively paying no tax on that. And this is a great strategy to utilize if you're carrying assets in your portfolio that are highly appreciated that you don't want to sell for capital gains tax realization purposes. So in summary, we just went over a step-by-step investing order for high income earners. We broke it down over 4 levels. The first level is financial security and debt management. Level 2, high return tax advantage investing. Level 3, taxable investing and wealth diversification. And level 4, estate planning. Mastering these levels ensures you reduce your tax burden, grow wealth efficiently, and reach financial freedom earlier. If you're a high income earner and want a personalized plan tailored to your financial goals, book a free consultation call with me at the link below. Let's build a tax efficient wealth accelerating strategy that works for you.